Okay, we are live. This is our very first live episode for 2021 Coffee with Bob. Thank you guys so much for tuning in. We're excited to be back. And with me, I have some of our investment crew here. Bernard Carter, he is our Managing Director of Investments here at H&A. He is a CFA and a CFP. And also with us is Bobby Hapanowitz. He is also a wealth advisor and helps head up our investment committee. Guys, thanks for being here.
Thanks for having us.
Thanks. Good to be here.
Good to be here. Good to do another quarterly market and economic update. Thank you guys, as always, for supporting Coffee with Bob and tuning in live. We're so excited to bring this episode to you. Feels good to be back in front of the camera live. So before we jump into the meat of the episode, a couple of housekeeping items. So for those who are tuning in for the first time, Coffee with Bob is a mini webinar series brought to you. Well, live episodes are brought to you once a month during the last Wednesday, 11 a.m. of every month. And then in between, we'll be bringing pop-up episodes to you. We'll be covering timely topics that we think you'll enjoy learning more about. Check out our YouTube channel. Search Hapanowitz and Associates YouTube or Hapanowitz and Associates in YouTube, and you'll be able to see all past episodes of Coffee with Bob. And as we start to broadcast more pop-up episodes and as more live episodes are recorded and broadcasted, we'll be putting them up on our YouTube channel. Check it out. A lot of great stuff there. We're broadcasting on another gloomy day in Pittsburgh, but that's okay. It's cold out there. It's warm in here because we are drinking from our Coffee with Bob coffee mugs. And you guys may have seen our private label Coffee with Bob coffee. So we wanted to put this stuff together as a thank you to all of you who support Coffee with Bob. If you guys want some private label coffee or a coffee mug, just let us know. It's as a thank you for supporting us. Or subscribe to our YouTube channel, share an episode with friends, family, spread the word, and we will send you some mugs and coffee as a gift, as our way to say thank you. At the end of this episode, we will be taking questions live. We already have a few that have been submitted prior to this episode, which I'll definitely be covering. But in the meantime, throughout the episode, feel free to submit your questions at the Q&A box that's either going to be at the top or bottom of your screen, and we'll be taking those live for you today. Should we dive into it?
Please.
All right, let's do it.
Go.
Okay, so we wanted to start this economic update for you by looking at this incredible picture here. So this shows S&P 500 returns for 2020, the entire year. I mean, look at that. This recovery, the magnitude and how quickly it happened is just, it was unforeseen. I recall conversations that we had within our investment meetings basically saying, we'll be happy if we break even by the end of the year. And look what happened. I mean, it's incredible. And a lot of people, understandably so, are asking why and how did this happen? We're pleasantly surprised and we're happy with it, but how? Given everything that's still happening and going on with the world, by no means are we out of the dark with the pandemic or with our economic recovery. So we're going to attempt to answer those questions today. And of course, we're always going to answer at the end of the episode, you know, looking forward, what can we expect going into 2021 as we continue with this year, and steps that you can take within your own investment portfolios and financial plans to prep ourselves for the future. So Bernie, what I'd like to do is focus more on fourth quarter and give us a highlight of what happened basically.
Yeah, well, thanks, Chris. Thank you all for being with us this morning. And Chris, you said it all. I mean, the charts, just it says 1,000 words, as the cliche goes about pictures. The depths to which we had gone in March. At that time, we were all saying, yes, if we can get out of this year -5% or -10% or you know, break even, it would be an amazing accomplishment. But not only did we surpass that, we blew through that barrier and went much higher. If you please turn to the next slide. So it was an incredible year for stocks, and in particular, in the fourth quarter of 2020, we really just shed any remaining vestiges where the market is concerned of any fear or any negativity about what's coming. It was all positive. Everything went up. Stocks globally went up. Credit bonds that are issued by corporations, they went up. So as we're saying here in the slide, the optimism was abundant, and it was very, very enthusiastically reflected in stock prices. I mean, the S&P had its best fourth quarter in 20 years. Incredible. And the economy did its part. It grew at a very brisk pace, over 7%. And so you can start to connect the dots as to why the stock market reacted the way it did in the fourth quarter. And Chris, if you could flip to the next slide, there's just a few more data points just to highlight the incredible story that was unfolding in the fourth quarter. Small companies, I mean, as much as large companies were up in price in the fourth quarter, as represented by the S&P 500, small companies just blew the doors off of every record. They were up over 30%. It was the best quarter by far for small stocks in the US. It was incredible. Energy, old-fashioned oil and gas companies.
Incredible.
Was the top performing sector in the fourth quarter. And what makes this so incredible is, if you recall back in March, when everything was shutting down and everyone stopped driving, everyone stopped vacationing and traveling for business, so planes were grounded, fuel was not being purchased, oil was not in demand. So the price of oil plummeted, and many were saying, wow, is this the end of fossil fuel companies as we know it? Are these companies done? Should we get rid of everything oil related or fossil fuel related in our portfolios? And wow, in the fourth quarter, it just raced to the top, was far and away the best performing sector in the market. And in particular, it trounced. It was more than double the returns for technology stocks, which had been the darlings throughout 2020 and really were the ones that were performing both in the stock market and as businesses, because these were the businesses that enabled us to continue to work and connect while we were at home.
I think that point is so important too, because investors who took a valuation-based approach to investing and rebalanced into that as that happened in March, participated fully in that rebound in energy. I mean, these aren't the companies, these value companies. You could see international companies, emerging markets companies, small caps all outperformed the S&P 500 in the last quarter here. And the reverse had been true for years. Investors who were disciplined in their approach to investing in rebalance participated fully in that. That's why, that could be so important to make sure that you're monitoring your allocations and rebalancing as necessary.
It goes to show you, there's an analogy that we like to use, particularly Bob, and the phrase he uses is a horse in every race. And it just goes to show you all the more, is maintaining a disciplined strategy and not trying to chase returns pays off in the long term. So specifically with energy, Bernie, why did energy do so well? Was it simply because of the uptick in economic activity? Or was there anything more to that?
Yeah, well, I think that was a big part of it. I mean, the theme in the market today is the back to work trade. The people are going to start to travel again and connect, and rising oil prices have been part of that. But I think perhaps even a bigger part is it just got so cheap. And admittedly, energy is a sector that has growth prospects that can be described as modest at best. And when you compare it to, say, technology, I mean, the growth glide path for technology is much steeper than we would expect for energy. However, when you have a sector such as energy that's maybe 1/6 or 1/7 the price in terms of valuation versus its counterparts in technology, the market is saying, wow, at these bargain basement prices, we can make money off of these stocks. These businesses, for what we're paying today, they're going to be very profitable. And that's a theme that has been in place for a number of weeks now, and it makes sense economically.
It's
Mhm.
absolutely incredible. It really is. So, okay, let's talk about the why behind everything. I mean, Bobby, I'm going to turn it over to you. What would you say were the biggest drivers behind the market activity that we saw, particularly in the fourth quarter of last year?
Sure. You know, the word unprecedented sometimes is thrown around too much anytime we have economic uncertainty, right? But in this case, with the coronavirus, over the last century, this truly was unprecedented, but so too was the relief measures, the stimulus that the government, you know, implemented.
Yeah.
We had the CARES Act back in March. The Federal Reserve has been buying bonds on a monthly basis and will continue to do so for the foreseeable future. Interest rates dropped. There have been direct payments to consumers, the PPP program. And, you know, as a result of that, the trough, the economic trough that occurred was was higher than economists expected. And the economic data since that March low has been better than expected too. Savings rates are higher than anybody could have anticipated they would be for individuals at this point in the recovery. Businesses have been able to pivot because there's so much capital out there, and borrowing is, you can borrow money for very inexpensive rates right now. Because of that, we've seen, quite frankly, less defaults than we thought we would. And all of this has been bullish for stocks. And because of that, we have hit those new all-time highs that Bernie was referring to. And, you know, again, we still are looking towards, you know, progress in the coronavirus vaccine, and we have made progress. And the market is sniffing a little bit of that out right now and seeing that the vaccine is being distributed. And that's also contributing to what we saw in the fourth quarter.
Sure. So, okay, one of these bullet points on here for our audience is mentioning the relief package. And, you know, a lot of people continue to ask, when does all of this help become too much help and have a negative effect on the economy? I mean, when does it become, you know, when do the tides turn in terms of this stimulus?
Sure. And that's a great question. It's one that investors should be asking. And, you know, to start, you know, the economic data in retrospect is showing us that stimulus was necessary and that we needed it to stave off the worst effects of the shutdowns. And it acted as that sugar rush, so to speak, for the economy to keep it going. You know, having said that, you know, you do need to watch out for inflation. It is a possibility. What the good news is right now, because interest rates are so low, the debt on the balance sheet of the U.S. government is in very low interest rate debt, which, you know, as they say, it's not about how much debt you have, it's about your ability to pay it off. Right now, we still have that ability to pay it off. Having said that, if we have to continue on this path of stimulus after stimulus after stimulus going forward, the risk of inflation does become higher. And that's why it all comes back to, are we able to open the economy? And that point comes back to, where are we with the coronavirus? How much progress are we making?
Bernie, we were talking earlier about trends in, you know, added debt under different presidential regimes. Tell us a little bit more about that.
Yeah, it's concerning. So under Bush, 8 years of Bush, the national debt increased like 86%. Under 8 years of Obama, it increased 88%. Under Trump, 4 years, it increased a little less than 40%. These are trends that, in the opinion of most, can't continue. Now, this time around, we did have, we'll go back to your unprecedented word, Bobby. It's a great word. We need to use it, you know, when it fits, and it fits here. These were unprecedented circumstances, and it's likely made tons of sense for the federal government to borrow money to inject funds into the economy to keep businesses going and to keep households financially above water. So that was necessary. But going forward, eventually the amount of money we're borrowing is going to need to be trimmed. We're not going to be able to grow, the liability side of our balance sheet at these rates forever.
Yeah, it's not sustainable. You use the analogy sugar rush. And when you think about it, a sugar rush for us as humans, we're feeling really, really good up front. And then it's not as sustainable of an energy source to keep us going at a high quality rate, whether we're working out or whether we're just trying to get through our day. So I think that's such a great analogy to use in terms of thinking about stimulus and, how much can we continue to afford more.
Yeah.
So regarding inflation, I mean, how long would it take for us to know whether or not there are inflationary repercussions from additional stimulus?
That's a great question. There's a lot of different variables there. It is thought, and it's one that we don't have a definitive answer on. It is thought that inflationary, practices or implementation of policy could have 3 or 4 years until that inflation comes to fruition. It's possible that there's a lagged effect. Having said that, again, a lot of different variables at play here, including how much more there is to what severity of money spending there is and stimulus there is, and when we're able to reopen the economy and how much the economy comes bouncing back, for lack of a better word. And, with that point, I think we have a slide that shows, the economic, what the projections are,
you mean here?
Yeah.
Okay,
Yeah.
we can skip to that. That's fine.
So you could see there, I mean, back in 2019, we had a, 2.2% growth rate in GDP. And that's been roughly average for the United States for the last decade or so, maybe longer. And albeit after a contraction in 2020, we are going to see a rate of growth that is double what we have seen previously. So for all the reasons that we talked about before, because of that stimulus, because of the positive economic data we're likely to see an increase in GDP going forward.
Yeah, absolutely. So I want to go back to this prior slide. Tell us more about some of the highlights of what we can expect looking forward into 2021 and beyond.
Yeah. So a lot of the themes that we've seen so far this year are going to be prevalent going forward. So, we talked about stimulus. The Biden administration and Congress are working on a $1.9 trillion stimulus bill.
Right.
And there's likely to be more to come. And that's going to include more direct payments likely. It's going to include relief for municipalities, for states. So a lot of stimulus coming, vaccine rollout initiatives. I mean, I'll use the word unprecedented again. It's unprecedented to have to distribute hundreds of millions, if not billions, of vaccines in such a short amount of time. And there are logistical restraints and challenges involved with that. But again, the more efficient we can be in getting that out, the better.
Absolutely.
And of course, the Federal Reserve has, signaled that they will remain accommodative.
Right.
So again, low interest rates. We're targeting a 2% rate, average rate of inflation now, not a top rate of 2%, which, is the Fed's way of signaling that a little bit of inflation is healthy. If we see a little bit of an uptick in inflation, that's a healthy thing. That could be stimulative for the economy. But it's just excessive inflation that we're looking out for and that we want to monitor.
Sure. Makes sense. So, it's also our job to keep our eye on any sort of warning signs or warning markers within the economy and within the markets. And Bernie, I want to turn it back over to you. I know there's some things that you wanted to talk about on this chart.
Yeah, this is a really good chart, I think. And first I want to refer back to the inflation discussion. And, where might that show up? So the bond market historically has been probably the best, canary in the coal mine to ferret out inflation. And we'll see that in rising interest rates. And we have seen rates rise a little bit late in 2020 and early in 2021, but they have not risen that much. It's been very slight. So far, the bond market is not yet a believer that inflation is a problem, but something to be closely watched. There will be spikes upward in interest rates. And really that's the source of the pressure. Bond investors demand higher interest for lending if they think prices are moving higher. If prices are going to stay steady or lower, bond investors are okay with reasonably low compensation for lending money. But if prices are going to go up, they're going to demand more interest for lending money. So far, that hasn't happened to any meaningful degree, but we need to watch it closely. The other part of this chart that I think is interesting is on the left, the chart of GDP, the glide path of GDP over the last 3 years. Of course, the data on the right-hand side is estimates. But so in the United States, we contracted in 2020. Everybody knows this. But one thing to keep in mind there in terms of cautionary flags is that contraction really took the economy in terms of its overall size back to where we were in early to mid 2018.
It's pretty, wow.
It's a deep hole.
Yeah.
It's a deep hole.
Yeah.
Those 4 and 5 and 6% numbers on the downside and the upside, they typically don't happen on either side, down or up. It's normally, ones and twos.
Yeah.
Yeah.
So, okay, so now the economy is sizing about where we were in 2018, but the stock market has zoomed. We're 60% higher than we were then. So it does beg the question, and Chris, if you could please flip to the next slide, it does beg the valuation question. And it is true that stock market valuations are at the higher end of the historical range. In fact, we've only seen stock prices this high really a couple of times over the past 100 years. So that's something to be careful of. Monitor your allocations to stocks, and we would say this is probably not a time to be over allocated to stocks. One of the other items is the market activity that we're seeing. When stock markets have peaked in the past, there have been some definite activity levels, particularly among retail investors, that have been associated with those peaks. One of them has been the issuance of IPOs or initial public offerings. And that's, for those of you who may not know what that is, that's private companies who are not traded on the stock market that then go public and their stock is listed. Now, when do you want to do that if you're a company? Well, you want to do that when investors are optimistic, when they're excited, and when they're paying top dollar. So today is the time that we're seeing record issuance of IPOs. Among individual investors, retail investors, we're seeing a lot of buying of stocks with borrowed money. That's called margin. That's reminiscent of market tops. Also, the option activity we're seeing in the market it's robust, and it is unusually tilted towards what you call bullish bets or bets that stocks are going to go up. That's reminiscent of market tops. And just before coming into the room today, Bobby and I were talking about there is this phenomenon that has just come up over the last couple of days where retail investors, individuals, are gathering on
GameStop.
GameStop is one of the companies. They are gathering in internet chat rooms, and they are essentially mobbing certain stocks and pushing up the price to really kind of corner investors who have sold the stock short or made a negative price bet on the stock. And it is putting some hedge funds out of business. They are raising the white flag. I've never seen this before. It's incredible. It is so fascinating. But it is, again, activity. You don't see this activity in a normal market. It's really an unusually optimistic market where you see this activity. So cautionary flags in these areas.
For our audience, just if you haven't already read about it, search GameStop and the story will come up. It's just it's fascinating, but it's also, to your point, it's just very sort of eerie, that kind of activity happening, for sure.
Eerie is a good word.
So, I mean, look, these markers that we watch, these considerations that we're keeping in mind and that we're seeing right now, does that mean that, you know, we should be pulling out of the stock markets or completely pulling out of an asset class or a sector? No, for the overwhelming majority of people we work with, the answer is no. But what that does mean is that there are certain tweaks that we can potentially make within the portfolio, certain strategies that we can implement to adjust our approach within the overall game plan. And of course, that's how we always like to round out these quarterly updates for you. So let's talk about some of, you know, we put some highlights together, some of the many things that you can think about. So let's talk about this. Who wants to go first?
Yeah, so one of the things, I'll go first. One of the things that investors can do today is, particularly if you were, as we were back in March, we were adding to risk assets in portfolios. We were selling bonds a little bit and buying stocks back in March and April. And we were also buying corporate bonds and getting rid of treasuries back at that time because corporate bonds were so cheap. Well, that has been a very profitable trade and it's rallied tremendously, mid to high teens, which is a lot for bonds. And to the point now where the corporate bond or credit risk side of our bond portfolio is it's very full and perhaps needs a little trimming because those bonds would be most at risk if the market did decide to take a bit of a downturn.
Right.
So that's an area that we're assessing closely, and we will likely make trims to that in the near future. And we would encourage investors to think about looking at your bond portfolios and making sure there's not too much credit risk in there.
And it's something that we were talking about earlier within our own bond portfolios, isn't that right?
Yeah, especially with duration. I mean, interest rates are just so low right now. And regardless of the reason, you know, whether it's inflation or whether it's the Fed deciding to hike rates, it's likely that, you know, at some point in the future that interest rates could increase. And before that happens, that tends to be a good time to limit your duration in a portfolio. So, I mean, from last year at this time to this year now, I would estimate that we've, you know, reduced probably 80% of our intermediate term bond position in our bond portfolio. Some credit that we're trimming back right now, lower duration on the bond side of the portfolio too. In the event that interest rates, you know, do increase at some point in the future. Something else that we've been doing too is again trimming back from stocks and rebalancing. This is very important. I mean, in the last 6 months of last year, we did several rebalances, and that looked different for different investors with different risk tolerances. If you're somebody who's taking distributions or withdrawals from your account to supplement income, we were filling cash buckets so that in effect you're taking income from the market's money, not from your principal. So that's very important. For other investors who might have a higher allocation to equities, to stocks, we were trimming from growth all these high-flying growth companies that have been surging at the beginning of the year into some of these more value companies. And, you know, again, we talked about this before, but, you know, some of these value names, they aren't necessarily the ones that you hear on CNBC every day. They're not the most exciting names, but that doesn't mean they can't outperform. Right. Especially, you know, the most important thing is that valuations are very low right now on those value companies relative to growth. That has widened out to levels that we haven't seen in years.
Sure.
And then when you consider that, you know, some of these cyclical companies that would be included in there are more construction rebound type companies that you would expect if there was an economic rebound. The Biden administration has signaled that they, you know, would consider huge infrastructure spending. These companies would serve the benefit from that. And so that's why it always makes sense to look at your portfolio, look at where your allocations are, and trim and add where it makes sense to make sure that you're back to your target allocations.
Absolutely. Okay, so I'll round us off. The second last bullet point here, closely monitor tax changes. You know, on the screen it says that may occur, but I think everyone that we've talked to in the last couple of weeks, the general consensus is that will likely occur. I think that's a fair assumption to make, more a matter of when and not a matter of if. does that mean that you should make a drastic change within your investment game plan or within your estate plan prior to knowing exactly how tax laws will probably change? In most cases, no. In most cases, we tend to caution against that. But stay on top of these changes. Your advisors will absolutely be staying on top of these changes. Work with your financial advisor, work with your estate planning attorney. For some people, once these tax laws do change, if they do, it may make sense to, tweak the plan just a little bit, maybe prepay some taxes and take a little more of a proactive approach in tax optimization to, the last thing anybody wants to do is pay a penny more to Uncle Sam than they have to. All right, so, and we always like to round out these quarterly updates with this one last message: review your plan. A sound financial plan is the backbone, will serve as the backbone for tough decisions or any sort of decision that you might have to make on your own or with your advisors, especially during periods of market volatility and economic hardship. When you had that plan to turn back to, that serves as your guidepost. It serves as your longer term and intermediate term benchmarks. And it really just, it puts things into perspective when, we're trying to make decisions within the investment game plan. So work with your advisors, as always, we recommend. And with that, let's answer some questions. So like I said, we have a couple of questions that were submitted to us prior to this episode, and I will get to them, but we have a couple that were submitted during the episode. So the first one, this is a good one. After the 2007-2008 downturn, how long did it take for interest rates to rise? Great question.
They've never really.
They haven't really.
They haven't gotten back to the
Right.
point. That's a really good question.
Mhm.
Yeah, it feels like for the past however many years we've been saying rates are at all-time historic lows, and it hasn't, the message hasn't changed.
And that's such a great question, and it brings up an important point that, just because we say it's possible that inflation could occur, nobody knows for sure.
Mhm.
We threw around the word unprecedented, I'll throw it around one more time. Back in 2007 to 2008, there was a lot of relief money that was distributed to the economy.
Mhm.
At that time, it was unprecedented too.
Mhm.
And there were a lot of really smart people on Wall Street who thought, okay, this is the thing that has to lead to runaway inflation.
Yeah.
And it never occurred. And it's amazing. Another story, about 20 years ago, there was a gentleman, an economist, who wrote a research paper that drew a line in the sand
Mhm.
for debt levels for an economy. If you're the United States or any other government, he argued that if you had, of your income, of your annual income, of your GDP, if you had 90% of that in debt,
Mhm.
so if you had a 90% debt to GDP ratio, that was the line in the sand where after that inflation was going to skyrocket, and it had everybody really worried. But then 90% came and went,
Mhm.
and again, nothing happened.
Yeah.
So again, it goes back to, what is your ability to pay?
Right.
It's not how much debt you have. What is your ability to pay off that debt?
Sure.
So something to look out for. Yeah.
Okay, the next question we have here: why are hedge funds getting beat by this mob investing? I don't understand. So I think this person is referring back to the Reddit story and
Yeah.
GameStop story. So
Yeah, it is really, really fascinating. So there is a technique of investing. It's called short selling. And when you short sell a stock, and not too many individuals do it, it's
Mhm.
mostly institutions like hedge funds, and they're expressing a view that a stock is overvalued and they think it's going to eventually go down.
Mhm.
So they will go into the market and borrow shares. And there are companies there are big custodians that make shares on their platforms available to borrow. BNY Mellon,
Mhm.
a Pittsburgh-based company, is a good example. They will lend shares to investors who want to short sell.
Mhm.
So you've borrowed something, you've taken it, and then you've sold it.
Mhm.
So you've sold something you don't own,
Mhm.
with the expectation that it will decline in price to the point where you will buy it back and return it to its rightful owner, and you're going to make the difference.
Right.
So that's how
Mhm.
short selling works. And in a normal market, there's an acknowledgement that your risk level is unlimited, because in theory, there is no limit to how high a stock price can go.
Mhm.
But in a normal market, that ultimate risk is never really thought about that
Realized,
much
yeah.
because stocks
Yeah.
don't move up that quickly. But today, what is happening is individuals, and I would just say there's some anecdotal evidence that a lot of this stimulus that is coming down is not buying bread and milk for
No,
families.
it's not.
It's going into the stock market
Yes.
one way or another. And that's
Mhm.
another kind of individual investor activity we think is unusual today. But individuals are gathering, they're mobbing on
Mhm.
chat boards,
Yes.
and they are looking for the companies that have the highest amount of short positions or that big hedge funds have high profile or well publicized short positions,
Mhm.
and they are buying the stock.
Mhm.
Buying is what makes, I mean, simple economics, buying is what makes something go up. Well, as they are buying the stock and it is going up,
Mhm.
the balance sheets of these hedge funds that have shorted it or sold it are getting decimated.
Mhm.
And their banks, and most hedge funds trade with borrowed money. Their banks are saying, look, you need to close this position out, which means they've got to go back into the market and buy
And
it, which
buy.
pushes it up,
Right.
or you've got to come up with more capital
Right.
to collateralize this position. And it just snowballs.
Yeah.
Everybody's buying until the stocks they hit the stratosphere.
So with the GameStop example, just not to spend too much more time on this, but with the GameStop example, hedge funds took a short position thinking that GameStop as a company is basically obsolete. And when you take a short position, you are betting that that stock price will continue to go down. And some person on Reddit has millions of followers and basically put out a message saying, let's see what we can do here. And all of his followers took, these are individual investors who don't have millions of dollars to invest. So it's people it's your neighbors, it's people walking down the street who have Robinhood, for example, and use that to trade. And and all of these people, mob investors as a mob working together to buy that stock. And to Bernie's point, that stock price is driven up. And they were saying yesterday, I think, for a certain hedge fund, if the price went over 200, that hedge fund would be out of business. And I think it was set to go over 250 for GameStop. So it's just,
It's crazy.
yeah, it's crazy.
Yeah.
It's crazy.
And this sort of thing is, look, this sort of thing is happening. This is essentially cornering a market,
Mhm.
so to speak. And this happened, with the robber barons. I mean, it happened with sugar and steel and gold and
Mhm.
silver. We can, think about some of the names that I'm embarrassed to say historically. I'd have to go back and think about the names that connect up to each of those commodities. But the J.P. Morgans, the Vanderbilts, the robber barons of the turn of the century, they threw their money around
Mhm.
and cornered markets and various commodities to put their competitors out of business.
Sure.
And this is kind of the same thing.
Yeah.
Mhm.
Yeah. Very interesting.
Great question.
Okay, so one of the questions we had submitted to us is, should I be putting my money into tech stocks?
Yeah, I think absolutely. You should continue to own tech stocks, however right-sized.
Mm-hmm.
And as Bobby had mentioned earlier, because of their returns
Mhm.
over the past couple of years, they've grown in portfolios to be too large, and they
Right.
needed to be pruned. So that's the direction we've been moving in, but we certainly wouldn't abandon them. I mean,
Right.
they've been the growth engine in our economy for years. They're likely to continue to be the growth engine, but they're expensive.
Yeah.
So you definitely don't want to over-own them.
Absolutely.
Mhm.
Okay. Another question we had: any particular asset classes or sectors that you guys see as really in favor or out of favor now that we have a new administration and Democratic control?
Yeah, I mean,
Congress.
we talked about that a little bit, with, if you believe that the economy will continue to rebound, some of those value type sectors
Mhm.
are likely to continue to do well. Again, the Biden administration has been very outspoken in that they want to do a lot of infrastructure spending. I mean, trillions and trillions of dollars of infrastructure spending. be great for the broader economy, that'd also be great for some of those construction, type companies, infrastructure type companies. Having said that, that's why it's important, again, going back to the basics, the principles, it's important to rebalance and make sure that you do own the appropriate amount in your portfolio for you.
Okay. The last question we had submitted to us before the episode was, are markets indicative of the economy, or is economic data indicative of what the markets will do?
That's a good question. Markets tend to lead. Markets you most often see reflected in today's prices, not what's going on today in the economy, but what's expected to happen in the near future. But markets are not always correct. There's a constant process of peering into the future and estimating what's going to occur. And if the estimates of the future become brighter, then stocks will continue to rise. If the estimates of what we think is going to happen a year from now begin to decline, then the stock market generally will quickly make an adjustment and can turn downward.
All good questions. We have one more question here. Okay, if all hedge funds, all right, so going back to hedge funds, if all hedge funds went away, should we as a society really care? Do they really add any economic value to our country economically? Or are they just bottom feeders earning huge commissions? What a savage question. But that's a great question.
Yeah.
No, I think that can be answered in so many different ways depending on your outlook. It's basically a sector of our industry, right? So the beauty of capitalism is that if a sector of a specific market goes away, it's usually because something else is replacing it, something better, something that has more demand at that time, something that's typically more cost efficient and more time efficient. Now, that's looking at things in general, but if hedge funds were to go away.
Yeah, I mean, the hedge fund industry provides, I guess, some support and service to pension funds, to annuity companies, to endowments, a lot of services that are critical to society and to the economy. Having said that, providing a service and earning your fee are two different things. I mean, hedge funds, the mandate is outperform your benchmark, and it's a fact that over the past decade or so, the vast majority of them haven't outperformed the benchmark. And as the question alludes to, the fees tend to be higher. So that's something to keep in mind, as well. Here at H&A, we believe that fees and taxes are two of the most important components to achieving a return. And high trading, high fee, high type strategies can serve to do the opposite and actually increase your fees, which will take away from your return. So that's something to look out for. Hedge funds,
just like active investing, tend to go in and out of favor over time. It's a cycle. So
some people say that because they engage in shorting, much more so than the general public, they have a function in keeping prices where they should be, price discovery, and more closely aligning prices with where they should be. But that they are expensive. They haven't hit their benchmark by and large over the last 10 years. So in a very competitive marketplace, if they don't earn their keep, then they're going to be they're going to have problems. And in terms of these funds who are in trouble because of this trading, we were discussing it, Bobby and I were discussing it. I feel bad for them, for the owners of the hedge fund, the business owners, and certainly the investors. But, you know, Bobby, as Bobby and I were talking, you need to understand the risk you're taking and you're, you know,
100%.
you're trading it.
Hedge
If
funds
you're,
are, they're speculative. They're known for being a highly speculative. Yeah,
there have been many high profile blowups of hedge funds over the years. So,
absolutely. It's a risk.
And
that you
especially
take.
shorting, that's a dangerous game.
Yeah.
If you're playing that game, it's a dangerous game.
Even more so to me, what I care more about when I think about this story is what about these people, you know, these individual investors who are part of the quote unquote mob, not meant to be a positive or negative term, but that's what people are calling it, who are putting their hard-earned money towards a company that was considered by experts obsolete. I mean, you know, that's more of the.
They're speculating.
Yeah.
They're speculating, aren't they? And there's likely to be, in the wake of this, there's likely to be some changes to policies. And
I think so.
Well,
I think so. 100%.
you make a good point. What's likely to happen first is these folks are going to be left holding the bag.
Exactly.
Because if you're paying $250 for something that's worth 10, you are going to be holding a bag.
What happens when all the excitement goes away?
It's
You
going
know,
back to $10.
and then they lost that money, whether they put
Exactly.
$200, you know, $200 is a lot of money for some people,
Right.
especially during these times. You know, so that's more of the aspect of it that makes me think about it more. And we were talking about greed and in the markets and speculative activity. I mean, and I think you mentioned it very briefly a couple minutes ago. That just speaks all the more to the kind of sentiment that there is right now within investors in general. And when we talk about where we are in the market cycle, it's just a really interesting, you know.
It's reminiscent of 2007 with real estate. There were many people who lost a lot of money buying real estate in you know, in the years leading up to 2007. But the banks were lending money with no questions asked. Didn't need to know your income or your credit score. They lent you money to buy a home. And many individuals unfortunately lost their money, but and collectively, you know, this could turn into a long discussion, but collectively, I think that created an issue with our economy that we're still working off. And that's one of the reasons why inflation has never taken hold. We're still working off that hangover from the years leading up to 2007, 2008. So yeah, what we're seeing today is the same sort of thing. It's individuals who are throwing large amounts of money collectively at asset classes or particular situations that are probably worth a fraction of what they're paying.
Exactly.
Yeah.
Really interesting stuff.
Very interesting.
So
Great questions.
Yeah, great
Thank
questions. What a way to round out this first episode of Coffee with Bob. Thank you all so much for tuning in today and for your continued support of Coffee with Bob. Stay tuned for the next live episode last Wednesday of February at 11 a.m. And in the meantime, we will continue to bring pop-up episodes to you. If you have any questions about anything we covered, or if you want to talk through any of these more, call us 412-261-5966. Email us. Our emails are at the bottom of the screen here. And we'll see you next time, you guys. Thanks so much.
Thank you.
Thank you.